Hey, T. Roy here with Hoodoo Financial, and I want to chime in on a question that was asked about holding your cryptocurrencies in your retirement accounts, self-directed IRAs. And so I'm gonna give you an alternative opinion. And so I think that's the brilliant idea. That is what I encourage folks to do. I'm start off telling you I can hook you up with self-directed IRAs at my firm, and we can hold cryptos in your retirement account, Roth and uh, traditional IRAs. All right, moving on. So why though? And I know the thing about, well, I don't want the government to know what's up and this and that and that and this. Yeah, you know what? I don't want the government to know nothing. I don't want the government to know, and that's because the other, we think of them as the government, right? But and so taxes and all of that, and they coming to get us, right? And so that's just a general fear that we as African Americans have, and so I have that same fear too, but I don't have. That's not even of a concern to me. It's with this question, because first off, it's better. I think the question was, what's the pros and what's the cons? Well, I'm just tell you some of the things that why I say you should. And so, one is this professional asset management. So you have a professional custodian that's holding your assets. So to me, this is far better than even how my money is stuck in Coinbase right now, and all these other apps and all. We get a lot of questions that, hey, I bought this crypto over there, I can't get it. I got this one over there, I can't get it. That's not even part of the game when you're holding it in your retirement account, because again, you have professional asset custodians that are holding these. So another thing, basically, is generally the your from a financial planning standpoint, you have you have different reasons to hold assets in different types of accounts. So there's a argument that I'm making is, it's not a either or, it's a this and. You need this and that, not this or that. So, and now one thing I want to tell you specifically in that cryptocurrencies investing is, I see it as a long term thing. So if you're a day trader type of person in your from a crypto, if you crypto day trading, you just trying to get paid right now. You trying to just buy it low and sell it high. That's really just all it's your only interest, right? Then of course you should not hold that portion of your portfolio should not be in your retirement account. But as it relates to, if you have a retirement account, if unless you are opposed to retirement accounts, then you should hold crypto in your retirement account. So, and it does have some, well, if this, if that, right? Depending on your age and all of that stuff. Then we could dive a little deeper into, well, maybe you shouldn't, or maybe you should. But how soon do you think you're gonna die? That's gonna be part of how I'm gonna give you your answer, right? And so if you think you're finna die in a couple years, maybe not. But if you still got life in you, yeah, you need some crypto in your retirement account. So here go one thing. So the analysts think that many of the analysts, including me and the other of the experts that are in this crypto course, believe that in 2030, Bitcoin is expected to be worth 500,000 per coin. So currently, what is it selling at? 33,000, right? It was up to what, 40, 60, I think, thousand, and then it fell back down to 29 or 30, somewhere around there, and now it's at 33. All right. So from now, we're in 2021. So we're saying in 9 years, some analysts say it could be somewhere between, and this is where I fall. I say it's going to be between 250 and 500,000 per coin. Okay, just that concept alone right there tells you you should hold it in your retirement account. Your retirement account is, just by definition for your retirement, which occurs at age 60, fill in the blank, 60 something. So so for me, I'm 52, 3, something like that. I can't retire till I'm 67. And so people before that, 62, I think, it's 65. Then it's 60, the others was 62. So you're in your 60s when you can retire. But the age 59 thing this is the earliest that you can start withdrawing from your retirement accounts without being penalized. And so at age 70 and a half, you must start withdrawing from your retirement accounts. Those are called mandatory withdrawals. And because basically, let's talk about, and that's because the government want their tax money. And so what is the benefit of a retirement account? It's a tax benefit to you. So in a you so your basics, Roth, and your traditional IRA, they're two different things, right? Roth is invested with after tax dollars, and so your withdrawals are tax free. So your after tax dollars grow tax free. Now, a traditional IRA is just like a 401k, where these your investment dollars are pre-tax dollars. So therefore your assets grow tax deferred. So these are tax deferred accounts. So that means that your account grows without being taxed on. You're not being taxed on the growth. So it grows on. It's, you got more money that can go in there. So for instance, let's say you make $50,000 a year. If you invest $5,000 into your IRA, then when you pay tax at the end of the year, the tax your taxable income is $45,000, right? So the government's saying you basically only made $45,000 this year. So that's great. Remember, you don't go around bragging, oh, I make this much money. I mean, you brag about it. Don't brag to the government about it, because you want to make as little money as possible, man. It's not how we sometimes we got to twist it. We thinking, oh yeah, I want to say I made this much. I want it to look like I made a lot of money. No, you want to make it look like you made a little bit of money. So anyway, back to my analogy. You make $50,000 a year. You invest $5,000 in your IRA. That means you're only going to be taxed on $45,000 of income. But where's the other $5,000? You still got it. But not only do you got it, it's in your retirement account making money for you. Remember, your money's supposed to be out there making money for you. Your money's job is to do work. Why do you have your money? If you got money in the bank right now, why? Is it doing any work in the bank? Nope. The money in your bank should be used to pay bills with. The money in your savings account should be used for, like you want to save and go on a trip, within the next 2 years. That's like short term monies that need to be liquid, and you can't put it at risk. So a savings account is the next step up from a banking account. So what I'm saying is you're going to get like 0.03% interest, maybe. And so how much is that? Nothing. So you got it sitting there doing nothing. Okay, so now so you should have the bank account and the savings account you shouldn't have much in there. You want as little in there as possible. Or at least that's my advice to you. So where should all your money be? The next step up from the savings is a money market account. So those are funds that are very liquid, but they are invested in money market instruments that are you can cash them out. So I mean we can dive into that a little deeper, but it's basically like corporate bonds and things, overnights and swaps and things like that. All right, step up from money market funds is your investment accounts that you taking various risks that are hot that you putting your money to work, but putting it to work means you're putting it at risk as well. And so then a step up from that is your retirement accounts, because your retirement accounts, theoretically, you have a longer time horizon for that. That's the benefit of a retirement account in the first damn place. So you get the tax benefit and you have the benefit of the longer time horizon on your investments. And then there's other things you need, insurances, things like that. And so we need to consider insurance as a form of investment. If you not necessarily like not your there's term and perm, so insurance. So term insurance, that's just I'm just paying you on a monthly basis to watch my back. But a perm, and so it's for a certain term. So you might get a 10-year term, 15-year term, 20-year term. So, but when the term over, the insurance over. So why would you do that? Well, because I might get 20-year term because you just had a baby, and then so I need to be covered for 18 years. So I get 20-year term, pay them $50 a month. They got my back, 200,000 or something like that, right? That's what term is. Permanent insurance is insurance that is not going to go away. As long as you continue to pay your premiums, it's not going away. And so what we want permanent insurance for is the cash value basis in there. The cash value life insurance has an investment component, so we can access some of those funds. Right now, back to the retirement accounts. Retirement accounts, being that they have this longer time horizon, you have the ability to take on more risk. And so just the concept of cryptocurrencies, that's a roll of the dice in the terms of risk. But from a long-term perspective, I'm advising you, I'm telling you, as a finance professional, a financial advisor, I believe in that. We can have that deeper conversation as an individual client, but because it's not just about what I believe, it's about what you believe. So I'm going to try to convince you as my client. I'm going to try to convince you, hey, crypto is not going nowhere. So let's get in where we fit in. So where should we put that? And so what I would tell you is that, so back to what I say in 2030, let's just say hypothetically, it's way under, we missed the mark. It don't hit 500,000 per coin. Some people say it's going to be 1 million per coin. So we ain't going to go there. Let's just say it hit 100,000 per coin in 9 years. That's 2030. All right. Then what that means is, if you are investing right now and you not gonna touch it till then, well, you should put some in you should put some at least in your retirement account. Now, you might, the argument, well, I need my money, right? That's always, I hear that all the time, why people don't want to do stuff in their retirement accounts. And then when they hit retirement, then you ain't got no money. You don't have no assets. Because if you have this in your basic, your on Coinbase and whatnot, and then you see this large dollar figure that you hit, you're gonna cash it out and you're gonna spend it. That's how that goes down. So now what's in your retirement? Nothing. You didn't do none of that. So you should have a well-rounded portfolio in your retirement account. And so your overall financial plan consists of lots of different investments, which includes real estate and other alternative assets. Remember, cryptocurrency is an alternative asset. Real estate is considered an alternative asset. Now, let's talk about self-directed IRAs specifically. Again, we could get self-directed Roth and self-directed traditional IRAs. So, in using self-directed accounts is excellent for real estate in some ways, because your real estate assets grow similar to like cryptocurrencies. You get these ridiculous out of the box, like, you know, off the chains returns, and it's not necessarily return. That's the wrong word. It's asset growth. So you buy a house now. You heard the story. You know, your grandmother bought this house, for 20,000. Now it's worth 500,000. My father just sold this house like a couple years ago, and they bought it for like 100,000, something like that. It actually was less than 100, and this is in Oakland, right? And so bought it for 100. It was less than 100, but I don't remember the exact number. And they sold it for like six something, like 690 or something like that. And they took that, and this house in the hood. It was bullet holes get shot through the house. So, so that's what I'm saying. It was a house in the hood, but it was a nice house. It was a big old kind of Victorian, but the projects was right across the street. It'd be off the chain. Like I say, bullet holes came through the door, the walls. You be in the door over there, and that's deep inside the house. So anyway, so that's the type of the growth of real estate. So investing in real estate with self-directed IRAs means the but you can't do it's a lot of limitations on that. So I can see, if you was interested and we connect, I can send you some ebooks and things that tell you some of the specific rules and things on self-directed IRAs. But but basically, a self-directed IRA is self-directed. So you in charge. So, although it's an advisor, I would be your advisor, or at whatever firm you're going to. Usually they don't give you no advisor. You just get it, and they have someone who is telling you technically what you do, right? And it's like, yeah, fill out this and send it there. Oh, next step is to do this, and then authorize that. It's things like that. That's what they're going to tell you. But what to do, they're not going to tell you, because um, mostly self-directed IRAs are just provided by the custodian themselves. So it's the firm itself. It's not an advisory firm. It's an asset custodian. So, but I utilize an asset custodian that allows me to provide my clients with self-directed accounts. So that's why I can advise my clients on what to do. Like, oh no, don't do that. Oh yeah, but do that. But it gets it's much more difficult, especially when it comes to investing in real estate. But after it's difficult once or twice, then it's not difficult no more. Then you know what you're doing. So it's that aspect of it as well. But back to the issue. So having cryptocurrencies and real estate in your self-directed IRA is a benefit. And then I also want to point out crowdfunding. You can do a lot with crowdfunding in your self-directed IRAs, and um, and peer-to-peer lending. And so I, I advocate. I'm an advocate of replacing your bond portfolio with peer-to-peer lending. So these are things like a lending club. Check out some of the things they do, and others. And so I'm always telling you, oh, I'm working on it. All right. So I'm working on having fill, dealing with the SEC so that I can have my own crowd fund portal, so that you can put your crowd fund, and if you want to start your business, we'll put the crowd fund put together, and you'll be able to place that on my portal and raise money that way for your app, your business, whatever it is. So those are the type of things that you can do in self-directed IRAs. But the theory on holding crypto in there is you are utilizing the longer time horizon. This is a very volatile asset. So hey, and let this volatility work itself out, and you don't have to give a damn about that. You just keep investing in the crypto inside your retirement and watch it do what it do. And so that's not saying don't invest in, on the apps, the Coinbase and whatnot, and Bit uh, Finance and all of that stuff. Yeah, fool with them too. But that's just because you want to be in it to win it and, spend it right now. And so I'm saying if you are concerned for your entire financial planning life, that will include having a portfolio designed for your retirement accounts. And so, and I put that plural on there, not retirement accounts. You need a Roth and you need a traditional IRA. And I suggest if you're really getting busy, you should have a self-directed IRA. Another thing though, self-directed IRAs do come with some higher fees. So it's not something you should do if you kind of like, oh, I just want to have it so that if I want to get down in some crypto in my retirement, if I want to buy some real estate, if I want to hold NFTs in there, well, nah, you got to be doing it because you're going to be paying a little more. So, like even right now, I can't just list off to you what the fees are, but I know that it's going to be about 2% of assets under management is going to be the fee, something like that. But really, that's less than the traditional firms charge you on if they were building customized portfolios for you at I won't give out their names, but the largest ones, well, they don't even want to fool with you if you don't have less than if you don't have more than $500,000 in investable assets off the bat. And since you have more, they're gonna talk more, do more, theoretically, but not in reality. But you know, you just get that impression that, oh, they big time, they're gonna do more for me, right? But um, therefore, they charging you more. So they charge like 2.5 percent of assets under management, and that's just for traditional accounts. Um, what they charge for your self-directed, I don't even know. I don't even know. But I know I'm just rambling on and on and on, but I'm saying you should have cryptocurrencies in your retirement account. You should have them. If you had to pick which self-directed account should I get, I'm gonna kind of lean towards the Roth because those are tax-free growth of your investments and tax-free withdrawals. And so the caveat there is, yeah, you will be penalized if you withdraw before the age of 59. I think it's 59 and a half. You will have to start withdrawing at 70 and a half. So think about that. So at 70 and a half, now we got to do a dance. The dance is between the various accounts that you have because you got to start taking money. The government is going to say you got to start pulling that money up out of there, man. You that 401k at that job and the last job and the last job and the last job, and especially if you what you should be doing every time you leave a job and you had a 401k. Well, what African Americans do, we got this special type of account. It's a special unemployment account. And what is that? That's a 401k. We use our 401ks for unemployment. We leave the job, we spend in that 401k for the next couple months until we find another job. That's not what it's for, but that's what we use it for. So that's how you end up at retirement with nothing. And so I'm telling you right now, don't do that no more. So what you should do is all those 401ks from them old jobs, you should have IRA, one IRA, and you should put all them 401ks. And I mean, you can have many IRAs you want to, but my recommendation is you should have one IRA. You should be monitoring and be in control of that one IRA. And so take all them 401ks, roll them assets over into the IRA. And in that IRA, you should have a customized portfolio for you that's built for your specific financial planning circumstances. understanding what your goals are, where you are, what you got, what's your family circumstances, and all of this, and that's what your portfolio needs to be based on. Not just, oh, I want to buy some Apple. Oh, I heard about this stock. Oh, I heard about that stock. Nah, nah. I think that's a recipe for failure. I have seen the failure in doing that. So anyway, what I'm saying, roll all them 401ks over into your traditional IRA. Why into a traditional IRA? Because your 401k is tax deferred dollars. So you can roll those over into another tax deferred account, which is your traditional IRA. If you could put them into a Roth, but you're going to have to do a Roth conversion. So you're going to have to convert these dollars in these assets into the Roth. That means you're going to have to pay up. You're going to have to do something. Okay, the government's saying, oh, you want to do that? Okay, cash us out now then. Cash me out, and then you can do what you want to. Put it in your Roth. That's basically what that means. So I'm saying, that I don't really like doing that. You should have a traditional IRA and a Roth. So open both of them. Now, if you really want to get down and post some cryptos, you're going to need a self-directed IRA as well. And so that self-directed account can be either one, the Roth or the traditional. I'm saying that should be, I don't know if I should say should be, I'm kind of suggesting make that a Roth, because we always crying about not wanting to pay taxes and stuff, and cryptocurrencies is decentralized. It's not government's money, right? So somehow we want to try to get out of paying taxes at all in the first place, right? And so that's one way that's going to help you out. Now, there are many types of assets that should not go in these in a Roth. What type of I mean, that would be a long conversation, but I'm just give you a for instance, like a municipal bond. You shouldn't hold a municipal bond in a Roth, because a municipal bond is not being taxed by a state. No, it's not being taxed, because the concept there is that is helping your municipality. You are buying a bond to build the road or something. So the government is giving you a break on that. So why would you invest in a asset that does not tax you in the first place, and hold it in an account that's not taxed? Well, you should just hold that in your regular account, your regular IRA, or your regular investment account. And similar to like a treasury is this is different tax advantages to hold treasury bonds and treasury bills and things like that. So you wouldn't necessarily want to put that in a Roth. So I'm getting into the weeds of it right now, but these are just kind of the things. This is some of the stuff related to that. So so bottom line, get yourself a self-directed IRA, especially if you're a real estate investor, especially if you invest in LLCs, because you can hold LLCs in your self-directed accounts, especially if you have a long time horizon for that investment, especially if you're a crypto investor, long-term crypto investor, generational wealth crypto investor. Let's talk on that a little bit. This is another reason why you should have it in there. If it's for generational wealth, so you need assets all across all these account types, and your retirement accounts have beneficiaries. So name your kids as your beneficiary and on your retirement account. So I don't wanna run out of money when I die. I want to be a whole bunch of money in there, and so holding these assets in these types of accounts, they avoid probate as well. So you have now, remember, crypto is kind of has some kind of weird type of designation that it's property. So it's just like a gold chain that's in your drawer, right? So that has to go to probate. So that's kind of like up in the air right now. So you have assets, and I would hate for this to happen to you, man. You hold your crypto in Coinbase, right? And so somebody got your access to your phone and all of this here, and you say, and you put the keys and all that so you can get into it. So the person who holds your assets now, this property, is actually the person who's gonna get your crypto. So it don't have to go to probate if they take it. It's theirs now. If they just pick your phone up and take it, yeah, hey, I could just transfer it over there. Right? I mean, I ain't gonna say you can just do this or just do that. It might be some hoops you got to leap through, but but one of them hoops might be probate, and that means the government can say, "Oh, you got a million in crypto, huh? Okay, yeah, we're gonna think about what to do with that. We're gonna hold that for a minute, and then we're gonna chop our cut out of there, and we're gonna take the tax and all of that, and then you can have what's left, or your heirs can have what's left. But holding your crypto in your self-directed Roth, for instance, you have a designated beneficiary there. So on the day you die, bam, this transfers ownership right then and there. It ain't got to go to no government, no probate, none of that. And it doesn't have to even be cashed out. It's just owned. So it's not, there's actually don't have to be a tax. Don't quote me on this one, but I don't think there has to be a taxable event right there. It's just true. You just now own those assets. Those your assets now. And at the cost basis of what the parent or whomever left to you bought it at. So, that's tax stuff. So, if some of you tax experts out there can tighten that up for me, but believe me, it's some tax consequences that will be in your favor if you have the crypto in your retirement account with a designated beneficiary on there. And so, but did you ever fill out some designated beneficiary at Coinbase? I don't think so. At wherever else you buy in crypto, I don't remember doing that. I don't remember doing that. I think if I drop dead right now, they would know that crypto would be lost. It'll be gone in the wind. They'll never see that again. So it's a thousand more reasons why I'm an advocate of self-directed IRAs. I mean, most of them have to do with real estate investing and especially investment clubs and just group economics. Then you should be involved with you should have a self-directed IRA if you involve in any of those things. And then I mentioned again peer-to-peer lending. So for instance, on the real estate thing, so this is how that works. So let's say you fix and flip houses, right? So you need $200,000. You're gonna buy the house for 100. You need another 100 to fix it up, and you're gonna